This is Terrence Andre Banks with Information Age Financial Solution, coming to you with an article from Economica blogspot.com. The author of this article at one time was closing down his blog, but I'm glad he decided to keep writing. This article is a little bit dated back in July 22nd, but the content is so powerful and so poignant to where we're living at now. I thought I'd just go back to it. He's got some new articles coming up, and I'll probably go into those as well on the channel and a future date. But how does this play out? Deceleration, interest rate, and asset price distortion, debt, deflation, depopulation, depression, and default. Okay, so he put everything in this particular title. As always, I'm going to put a link inside the description, but let's dive right into the article itself. Some folks have asked how the current population and demographic scenario plays out and the impacts on economics, financials, politics, and the environment. To give my best 2 cents, I offer the concept of stock versus flow. The world is all about growth, month over month, quarter over quarter, and year over year growth. Not stock, but flow. In a world of 7.8 billion persons, from a growth perspective, all that matters is that year over year growth of the population, the economy, financial assets. Obviously, I'm going to focus on the nexus, population growth, according to UN. According to UN World Population Prospects 2019, linked here. Now, it gives a link here. I'm not going to go into that now, but once you take a look at it at your leisure, I did do it when I read this article. From 1950 to 1988, total year over year, global population growth accelerated from 48 million a year up to 93 million per year per the chart below. But since 1980, total year over year global population growth has been decelerating, now growing only 81 million annually in 2019, or 12 million fewer than the peak in 1988. By 2050, the UN estimates that total year over year growth will be somewhere between 48 million a year, medium variant, to just 10 million a year, low variant. Okay, and I love his charts here. He shows this so you can take a look at it. But the world is characterized by stark inequalities among the haves and have-nots. The World Bank is kind enough to categorize the world nations into 4 buckets by the Atlas Growth National Income per capita, geographically detailed here and listed here. Again, he always gives reference points, so he's not talking out his ass. High-income nations range from 84,000 to 12,000 per capita. Under upper middle income nations from 12K to 4,000 per capita. Low middle income nations 4,000K to 1,000K, and low income nations less than 1,000 per capita. To simplify what is taking place, I sweep the high and upper middle income nations 0 to 65-year-olds population together, the blue line below, as these nations represent 90% of the global income. This one gets really interesting. Savings, because I'm kind of jumbled that steps up, as these nations represent 90% of the global income, savings, and access to credit. They consume 90% of the energy and purchase 90% of the global exports. They drive global economic activity. Likewise, I sweep the have-nots 0 to 65-year-old population together, the tan line below. The momentous takeaway should be that the population growth among the 0 to 65-year-old consumers is on the precipice of ending. See, our economies and most economies are based on some level of consumption continues to grow. What he's showing here, the people who have the most income is declining dramatically. And then with the people who have a fewer income, the non-consumers, is growing dramatically. The lack of an effective transfer of wealth and demand transfer from haves to have-nots is now a huge issue. Perhaps it's easier to see the annual change in the 2 population sets as annual growth among the consumers peaked in 1969, the blue columns below, and have been decelerating for nearly 5 decades. But according to the UN, growth of the global 0 to 65-year-old consumers will cease in 2023. Repeat that again. The growth of the global 0.65-year-old consumers will cease in 2023, and declines among the consumers will accelerate, reaching up to negative 20 million annually by 2053. As for the non-consumers, the tan columns, they have progressed up and through peak growth and are now beginning a secular deceleration of growth. Wow. To highlight which group drives demand, consumption, inflation, I added the federal funds rate yellow line. The FFR clearly tracked the accelerating and then decelerating growth among the consumer, and the case for zero interest rate policy is pretty plain as the collapsed number of consumers versus rising total assets is imminent. So essentially what's getting at here is that The people who actually have the money and doing the consumption is actually declining. And this individual, the people, the poor nation, where they expected the non-consumers who were supposed to come in and fill the gap are not. And this is where the federal fund, and that's why they created zero interest rate policy to hopefully to spur demand. So as the growth among the consumers accelerated from 1950 through 1980, the Fed strangely made capital prohibitively more expensive, thus capping the growth of capacity against fast rising demand, thus stoking inflation spirals. Then as the annual growth in demand began to accelerate from 1980 to present, the Fed made capital aggressively cheaper, stoking overcapacity and deflationary excess. If the Fed's goal is to manage the economy and inflation and jobs with that context, the interest rate curve should have been the inverse, supporting growth in capacity alongside accelerating growth in demand from 1950 to 1980. And once demand was waning, higher rates would have been sensible to avoid cheap money fueling the creation of capacity into decelerating demand. Whether the Fed's and the like central bank's intention was to strangle global economic activity and stroke inflation to control population growth, I have no way of knowing. But with widely accessible birth control making childbirth a conscious determination and cost of living rising well in advance of wages, each asset bubbles push fertility rates and population growth down further. So whatever the Federal Reserve has done, whether creating asset bubbles here, creating the cost of living to go extremely high, they've pretty much doomed the economy because people don't have kids when they don't have capital to support them. And this is what he's getting at here. The chart below shows fertility rates from 1950 to 2020 and UN medium and low variance through 2100. And I'm saying this is, I'm kind of backtrack and slow down just a little bit here and saying that each economy is based on individuals being able to take care of the older population in the back, and that's how most of these social networks and social security or any kind of social program is designed. You want to have more people coming in to fulfill the people that are retiring or getting older. The chart below shows, but this is not going to happen if the population does not continue to grow. And that's what he's explaining here as well. In addition to that, the individuals who have the money, which is the large consumer base, is declining at a rapid pace as well. So the part below shows fertility rates from 1950 to 2020 and UN medium and low variance through 2100. The UN predicts that in 2020, all regions except Africa will have fertility rates below 2.1 or negative fertility rates. Okay, Asia is anticipated to turn negative by 2025. With a surprising expectation that the North American and Europe fertility rate will rise, particularly as they both continue to collapse to all-time lows since 2007. As for Africa, fertility rates are plummeting and expected to continue doing so, but the ongoing growth that Africa represents is now translating as its very low immigration rates, particularly compared to Central America or South Asia. Again, the chart here. So if taking fertility rates and declining childbearing population among the consumer nations ever since 2007, the confidence level is very high that growth isn't coming back any decade soon. The chart below shows the annual change in the childbearing populations of consumers, blue columns, and non-consumers, the tan columns. And here again, you see that declining rate. You see here, they're even declining here. That's already in advanced stages. Again, I include that the federal funds rate, as it is nearly a one-to-one match with the annual change of the consumer nations, childbearing population, and change in demand they represent. The implications of the population growth leads, change in demand, and the federal fund rates follow. So ongoing rate policy should be hard to decipher. What happens now? A declining global workforce among the consumer nations, aka declining potential consumers, versus the overcapacity of real goods, services, and assets, real estate, stocks, bonds, commodities. This is a deflationary spiral only exacerbated by low rates and incenting even more capacity creation thanks to ZERP, or more likely NERP, paying debtors to take out further loans. The cheap money is also fueling innovation, automation robots, and autonomous vehicles. All good things in a vacuum. I'm going to repeat that again. These are all good things in a vacuum that are all further exacerbating the inflationary spiral via ever-grading capacity absent, creating like demand. Global commodity demand is likely to likewise to collapse far sooner than anticipated, and large overcapacities will likely stymie further green efforts. This cheap money is rewarding asset holders more than wage earners, particularly asset-light or asset-less young adults who comprise the childbearing population. These policies of inflating asset prices are rewarding elderly and institutions who own the bulk of assets over the young adults who are being penalized with record rents, home prices, insurance, medical costs, daycare costs, and student loans, etc. All this is further delaying marriage and family formation and only pushing fertility rates toward the low variant. The global population is set to peak far sooner and more dramatically than UN's current 2100-ish date. As the Ds are now in play in the rearview mirror are the deceleration of population growth and concomitant decelerating economic growth, interest rate distortions to provide false signals to the market, resulting in excessive personal, corporate, and federal debt. The interest rate distortions have and continue to push asset price distortions. Currently, deflation is sweeping the globe, leading to upcoming outright depopulation, depression, and ultimately corporate and or national currency defaults. A debt and leverage-based monetary system premised on continually stealing demand from ever greater future is simply broken now. The Ponzi is now clearly visible. How can perpetually even more debt, upwards of 250 trillion, be repaid or even serviced by ever fewer persons of means? That's the question he's proposing here. But central banks are sworn to see this to its broken end. A terrible daisy chain of events has long been underway, and although we still have better options at every fork, we seem to take the wrong turn. In the not too distant tumult, those least responsible and those who played by the rules will likely disproportionately suffer the consequences as the bedrock on which they have built their homes, retirements, and dreams crumbles away. This gives a very dark picture here, but it's just something for you to understand. We cannot have continuous growth in a finite planet, and we cannot continue taking on debt forever, especially as the population continues to decline, because there is no economic incentive for people to continue having kids and continue to even continue, because there's no jobs to even fuel this consumer demand. Unless something drastically changes, what he's stating is we're going to see depression. And he's using data and charts to show this. You need to think differently. You need to do everything differently and throw out all the old adages that you had in your mind of how things used to work. This is coming up in the near future. So if this video has been any value to you, please subscribe, leave some comments, pick the like button for upcoming videos, and until my next video, I'm out.